to one question and one follow-up question. I will now turn the call over to Patrick Jobin, Sunrun's Investor Relations Officer. Please go ahead.
Thank you, LaTanya. Before we begin, please note that certain remarks we will make on this call constitute forward-looking statements related to the expected future results of our company, including our Q3 and full year 2026 financial outlook, and other statements that are not historical in nature, are predictive in nature, or depend upon or refer to future events or conditions, such as our expectations, estimates, predictions, strategies, beliefs, or other statements that may be considered forward-looking. Though we believe these statements reflect our best judgment based on factors currently known to us, actual results may differ materially or adversely. Please refer to the company's filings with the SEC for a more inclusive discussion of risks and other factors that may cause our actual results to differ from projections made. They refer to certain non-GAAP measures, including cash generation, creation costs reflected in operating expenses, and creation costs reflected in capital expenditures, which are not measures prepared in accordance with U.S. GAAP. These non-GAAP measures are being presented because we believe they provide investors with a means of evaluating and understanding how the company's management evaluates the company's operating performance. Reconciliation of these measures can be found in our earnings press release and other investor materials available on the company's investor relations website and accompanying this webcast. These non-GAAP measures should not be considered in isolation from, as substitutes for, or superior to financial measures prepared in accordance with U.S. GAAP. On the call today are Mary Powell, Sunrun's CEO, Danny Abajian, Sunrun's CFO, and Paul Dickson, Sunrun's President and Chief Revenue Officer. A presentation is available on Sunrun's Investor Relations website shortly after the call. Now let me turn the call over to Mary.
Thank you, Patrick, and thank you all for joining us today. Sunrun is successfully executing a transition towards our direct business, which has higher margins, better customer satisfaction, and better credit profiles. We had positive cash generation in the quarter while executing a sizable safe harbor investment. We are delivering award-winning customer experience and laying the foundation for durable, high-margin growth in the periods ahead. We resumed strong growth in sales activities in recent months and expect to be exiting the year growing by over 10%. This tees us up well for a very strong 2027. Sunrun's energy assets are at the center of a power sector that is in need of energy capacity and where speed to power is critical. Sunrun now has over 4.6 gigawatt hours of storage capacity installed across the country and is the largest residential independent power producer. We continue to generate strong demand for our storage offering and set a new record in Q2, reaching a 74% attachment rate. This equates to the installation of over 15,500 battery systems in Q2. Aggregate subscriber value for Q2 was nearly $1.2 billion, near the top end of our guidance range of $1.1 to $1.2 billion. In the quarter, we produced positive cash generation of $45 million when excluding $22 million of equipment safe harbor investments. Excluding safe harbor investments, we have produced positive cash generation in the first half of the year and $428 million of cash generation over the last 2 years. We are adjusting our full year guidance. Three things. First, we are further reducing our outlook for volume originated through our affiliate channel due to deliberate reductions we made and the bankruptcy of Freedom Forever. Second, the ramp of sales activities and the process of onboarding new reps took more time than expected. This trend rates have inched up over the last few months. Our monthly sales trends in our direct business have inflected in June and July, turning positive, with monthly sales in shortly. Strategically, Sunrun is executing well, building a base of valuable energy assets. At the end of Q2, we had installed more than 266,000 storage plus solar systems, representing approximately 4.6 gigawatt hours of networked storage capacity. We are creating a formidable network of flexible, dispatchable power at a rapid pace. Sunrun added more than 1 gigawatt hour of storage capacity and dispatched more than 700 megawatts of power over the last 12 months. This is equivalent to dozens of peaker plants to generate approximately $40 million in GAAP gross revenue and greater than $10 million in operating margin in 2026, with substantial growth expected in the years ahead. We remain on track to reach our goal to over 10 gigawatt hours of dispatchable capacity online by the end of 2028, more than doubling from current levels, and we expect revenue to grow materially faster as we continue to secure commercial opportunities for the fleet we have built. Conversations with potential off-takers have inflected materially in just the last few months. Our large scale of dispatchable resources participation, retail electricity providers, and large load users such as data center hyperscalers. Sunrun is well positioned in a market that is structurally short power and where speed to power is a critical bottleneck. To this end, in June, we announced a framework with Renew Home and Test burden of traditional generation. In July, we launched a distributed AI compute pilot using our home footprint not just as a power resource, but as an edge compute platform. Commercial momentum is accelerating as the market turns to us for the scale, assets, and customer relationships that would otherwise take years and billions of dollars to replicate. We remain sharply focused on growing our direct business. It's our highest margin business. It allows us to drive competitive advantage. Earlier this year, we shared that we expected volumes in our direct business to grow. Volume growth in our direct business is ramping from negative growth in Q1 to double-digit growth exiting this year. This results in full-year growth of low single digits. Over the past few hundred people year to date, far outpacing what is seasonally typical, as we backfill what was a deliberate reduction in sales capacity in mid-2025 due to tax bill uncertainty as we position for growth. Importantly, this hiring is response to demand signals we're seeing for our battery offerings. Some of the talent we are onboarding from the industry is taking more time to acclimate to selling our more sophisticated product. We are being deliberate about that ramp, and we are building out our capacity to expertly guide customers through complex rate environments while presenting our full suite of advanced offerings. Growth. New customer growth is only one lever. Increasingly, we're focused on unlocking value from the customers and assets we already have. Our distributed power plant business is a good example of this, monetizing capacity we've already installed and turning existing systems into a recurring, high-margin revenue stream. And capacity markets, we expect this to become a larger contributor to cash generation over time. We're seeing a similar dynamic play out in add-on batteries. As resiliency becomes a bigger priority for homeowners, existing solar-only customers, and even homeowners without solar are increasingly choosing markets. Between distributed power plant programs and add-on batteries, we're building substantial recurring cash flow streams that are additive to our core origination business. Before handing it over to Danny, I want to take a moment to celebrate some of our people who truly embrace our customer-first service mentality. Capabilities for Sunrun customers into an opportunity to also serve non-Sunrun customers. Our service organization is well positioned to drive additional recurring cash flow growth. Connor and our regional service managers, thank you for the customer-focused execution that makes this possible.
Thank you, Mary. In Q2, up 1 point from Q1. Our volume performance in Q2 continued to be impacted by the transition we are strategically undertaking to grow in our direct business while reducing volume through our affiliate channel by applying more stringent requirements. In our direct business, volumes are up by more than 20% from Q1 and more focused and margin-driven approach. We expect year-over-year volume growth in our direct business to resume in the third quarter with second half growth exceeding 10% versus the prior year. Our monthly sales trends in our direct business have inflected in June and July, with monthly sales growth exceeding 10% compared to the prior year. Affiliate volume was down 30% in Q2 compared to Q1, and down more than 70% year over year, driven both by our decisions to scale back our affiliate partnerships and by continued challenges in the dealer ecosystem. This includes the impact of the bankruptcy of our partner, Freedom Forever. Origination volume for the year. We remain confident in our actions to reduce affiliate volumes given the growing divergence in origination quality, customer experience, and margin profiles between our direct and affiliate businesses. Aggregate contracted subscriber value was $1.1 billion in Q2. Storage attachment rate, a higher average ITC level, and lower capital costs. We estimate upfront proceeds will be approximately $52,000 per subscriber after applying an advance rate of 94% against aggregate contracted subscriber value. We estimate upfront net subscriber value of approximately $2,000, representing a margin as a percent of contracted subscriber value of approximately 4%. This figure was lower this quarter, owing primarily to timing effects, including more front-loaded costs from our transition toward a higher direct mix. We expect this margin to increase next quarter. We have introduced two new non-GAAP metrics: creation costs reflected in operating expenses and creation costs reflected in capital expenditures. Furthermore, Sunrun no longer reports aggregate net value creation metrics, including net value creation, contracted net value creation, and upfront net value creation. These changes are a result of a comment letter, which is now resolved. We will continue to report unit volumes and unit economics, which we believe are important operating measures for investors to track in Q2, or $45 million, excluding the $22 million net investments in equipment safe harboring. Cash generation is a non-GAAP metric. Please reference the earnings release and other associated investor relations materials published today for a reconciliation to its most directly comparable GAAP measure, cash provided by operating activities. Turning now to our activity in the capital markets. Sunrun is executing well. We closed multiple tax equity funds and ITC transfer groups have largely completed their 2025 tax credit purchases and have gained better clarity on their 2026 tax appetite. Corporate tax credit buying activity has followed, a continuation of the momentum we described last quarter. ITC pricing during the quarter remained relatively stable compared to Q1, with transfer deal pricing ranging from the high 80 to low 90-cent range. Treasury guidance on fiat ownership restrictions remains outstanding. And once published, we expect that the subset of multinational tax equity investors awaiting this guidance will emerge from the sidelines, further improving ITC pricing. Projects for subscribers beyond what was deployed through the second quarter. We also have over $840 million in unused commitments available in our non-recourse senior revolving warehouse loan to fund over 340 megawatts of projects for retained subscribers as of the end of Q2. Year to date, we have raised approximately $1.5 billion in non-recourse asset-level debt financing. We recently priced a $267 million public securitization, our second transaction of the year, at a spread of 200 basis points, a 20 basis point improvement from our most recent transaction in Q2. We expect additional securitization activity during the second half of the year. Approximately 32% of our subscriber additions in Q2 were monetized through the non-retained or partially retained model. As a reminder, proceeds from these transactions are equal to or better than our on-balance sheet retained monetization, while also providing simpler GAAP treatment to our customers. Turning to our outlook on slide 23. We are revising our aggregate subscriber value guidance to a range of $4.6 to $4.9 billion for the full year, compared to our prior guidance of $4.8 to $5.2 billion. We are revising our cash generation guidance to a range of $200 million to $375 million for the full year, before investments in safe harbor equipment of between $50 and $100 million. We have reduced our volume outlook for the full year, principally driven by a reduction to our affiliate volume and a slower sales ramp in our direct business than we initially forecasted as we undergo setting us up well as we enter 2027. In our affiliate route, we expect installation volume to be down more than 60% this year. In addition to these volume trends, sustained higher interest rates have also modestly impacted cash generation. We expect to continue to allocate cash generation. Operator, you can now open the line for questions.
Thank you. We will now conduct a question and answer session. If you would like to ask from the queue, we ask participants to please ask one question, limit themselves to one question and one follow-up. One moment while we poll for the first question. The first question is from Brian Lee with Goldman Sachs. Please proceed.
Hey everyone, good afternoon. Thanks for taking the questions. Maybe Danny, since you ended the call with your remarks, question for you first. You mentioned the recent ABS transaction. Congrats on that, 200 basis point spread. I think that's the tightest we've seen in maybe a year and a half or so, maybe even longer. Can you kind of speak to the financing environment? I know you're talking about a little bit of a pinch here in terms of higher cost of capital. Maybe that's just all the base rate, but how should we just generally think about cost of capital trends from here on out through the rest of the year, and then any visibility?
Great question. And, we did notice a difference in participation levels, depth of order book. We've been in constant communication, obviously, directly interfacing with investors. So, overall tone in the capital markets has been quite good, where several more people waited until this year to participate. And we're definitely seeing that in the results here. I would focus on, from an overall all-in cost of capital standpoint, we've seen some spread benefit. We've also seen increase in base rates. Taken together, we still support and enabling what we have planned for the rest of the year. Very positive signals from the ABS market. The other part of capital markets for us is the ITC transfer market, which has also been active. I think we noted last quarter there was an improvement of price that largely held this quarter based on the transaction activity we've seen and are currently seeing in our pipeline. And we also remain optimistic there, as we noted in the remarks, as fiat guidance comes out, that would only be additive to the market in terms of boosting participation, where we see participation already at a healthy place.
Okay, helpful color. I appreciate that. And then maybe a bigger picture question. I don't know if this one is maybe for Mary. Just thoughts on the battery storage opportunity. Obviously, you guys have pushed hard on that and been very successful. Be curious versus you seems pretty stark. So wondering, at a high level, if you're contemplating any strategy shifts or opportunities to sort of target other end markets, given you've got quite a bit of traction and scale already. So curious if you're thinking broader about the battery opportunity. Thank you.
Yeah, hey Brian, nice to chat with you. For a strategy that we adopted, as you know, many years ago. I mean, we are sitting on top of 4.6 gigawatt hours. And yes, there are some new entrants, that again are after the same thing that we've already built. And we're already sitting at we are sitting at the largest scale in the United States from a residential perspective. So as I say, we are the nation's largest residential independent power producer. And because of the importance of speed to power right now, and because of the importance of the demand, particularly from AI, but let's be real, there was already demand and challenges from a grid perspective that were already in place a number of years ago, that has just added to the importance of speed to power, meeting the need. The conversations that we're having, not just an acceleration of conversations with commercial partners, but I would say a very varied list of commercial partners. So I think we're in a great position to monetize the value of these assets for the company. And of course, that also brings some value for customers as well.
Thanks. Good afternoon, everyone. I guess just kind of drilling down on tax equity and pricing there. Sounds like it may have softened a little bit from last quarter, kind of in the high 80s, 90s versus low 90s last quarter, if I remember correctly, your comments. So 7. So kind of is the outlook for pricing, do you expect it to be stable or potentially some further pressure? And then what kind of assumptions are assumed in the revised guidance around tax equity pricing?
Yeah, I would say it stayed stable to Q1. So we are giving a range, high 80s to low 90s. So that's not implying any sort of change from last period. Pricing is held. To answer the question on future direction, we saw this year kind of get a little. There was a start of activity after some people were paused due to tax appetite uncertainty. We've certainly seen 2025 volume mostly or entirely clear the market. And then we've seen focus turn heavily to 2026 as people have been working sequentially themselves in their own tax planning. So velocity volume has picked up. Which means as you get towards the back half, if you're in the back half of the year, urgency for both counterparties picks up to get your 26 activity done. And what was noted was a little bit lower pricing in Q2 generally in the market. Different quality getting done at different prices or different types of assets. But we haven't seen a difference in price in our transactions, and more activity should unlock higher price. We expect modestly higher for the year, maybe flat to modestly higher, just to be a little bit conservatively grounded there.
Gotcha. That's helpful. Maybe switching gears. So on the distributed AI node strategy, I guess the first question there is, how quickly can you move from pilot to commercial deployment? And then maybe just on the financing strategy and funding model, should we expect the GPU investments to sit on the balance sheet, or would you look to bring in third-party capital? I mean, I know it's probably small numbers, but they add up pretty quickly if you're funding the GPUs. So just trying to unpack that.
Yeah, thanks for the question. We're excited about innovation and exploring the power of distributed compute because, again, we sit on the largest number of customers and homes across the country where people generate and store their own power. And so it's a really interesting way to think about creating value both but Paul, why don't you talk a little bit more about the distributed compute pilot and then take that other question on the funding and how we're thinking about it.
Yeah, for sure. So I think one of the things we know we have is a lot of customers with controllable power, and we can allocate that power to flow through, a meter, and we've And when you look at the value of using those electrons to power a GPU in someone's home versus the alternative, the returns to us are really, really attractive. So we're excited about the economics of it. We've got, as you know, over 1 million host customers today with our solar